Welcome, everybody, to the Dream Plan Retire Studio. I'm Andrew Raffel, and I have with me my trusted partner, John Jangle.
How's it going?
Today, we're going to talk all things required minimum distributions. This is a topic, John, that we get obviously a ton of questions on. Just recently, over the last few years, what's happened with just the age limit of RMDs? It's have confused people.
Right. Yep. And some of the changes behind pushing back when you have to start those RMDs. A lot of data to consider for your individual situation. So we thought we'd go through kind of 10 myths surrounding RMDs today.
10 myths, 10 mistakes. Lots of good stuff on here. So why don't we start off on mistake number 10?
Mistake number 10 would be rolling over your RMDs. So that would be, hey, I'm going to take out my required minimum distribution and try and put it back into a retirement plan. That's a big no-no.
Big no-no. Don't do that. Mistake number 9 is the husband and wife combining RMDs. So this is a big one that we get. You have an IRA, your spouse has an IRA, and you decide, okay, I've got to take out $15,000 in total, and I'm going to take it all out of my IRA. John, is that a bad move?
It's absolutely a bad move. You have to take it respective to your own account.
It's treated as your own island. Your IRA is yours. Your spouse's, your partner's is theirs. So don't make that mistake because the IRS will come get you at some later point.
That's true. And then also talking about that liquidity or taking that money out. So mistake number 8 is with your investment strategy, not having enough liquidity, meaning if you have certain investments like annuities or real estate that may have some limitations on how much money you can take out, not having enough of that liquidity to satisfy your RMD, kind of putting you behind the 8 ball.
The old self-directed, which a lot of people love investing in real estate inside the self-directed, but then they get into trouble once they hit the magic age of 73 because they don't have that liquidity. So that can be a big mistake. Make sure that you're on top of it if you do have that self-directed IRA. And a lot of times, too, there's nobody there to help guide you through on that.
That's right.
Next one is taking credit for withdrawing excess in the previous year. Well, what does that mean in English? Let's say you missed your RMD in 2023 and you realize that, oh, no, I forgot to take it. Well, the best and the smartest move is take that one as quickly as possible.
Right.
That's awesome. But you can't count that 2023 missed RMD as part of your RMD for this year. You have to look at this year as its own year. So you're going to have to get additional monies out. If you don't do that, then you're falling into the same trap and you're going to have to take an excess withdrawal the following year. So very important on that one.
Yep. And myth number 6, which I've actually come across quite a few times in the practice here, is an individual coming and saying, you know what I want to do? I'm going to take my RMD and I'm going to convert it to a Roth. So I'm basically going to get it into a pre-tax account. Well, you can't do that. You can't take, let's just say your RMD is $10,000. You can't take that out and say, I'm going to pay taxes and move it over into the Roth. You can still do a conversion, but you must satisfy your required minimum distribution first. So both of those transactions, the required minimum distribution, and then any Roth conversion you want to maybe do on top of that, those are all fully taxable.
Yep. And then myth number 5 is making traditional IRA contributions after RMDs have started. Now, this is one that used to be a rule. Then since the Secure Act, that rule has changed, which ultimately means that you can actually add to your IRA if you're over 73 or over, as long as you have income coming in, you can now continue to contribute to an IRA account. But most important, even if you do that, you have to make sure, though, that you withdraw your required minimum distribution from any of your pre-tax accounts. So don't make the mistake that, hey, I put into my IRA because I'm still working, and if you have an IRA, you have to take out the required minimum distribution. Whole other caveat there is if you are still working full time and have a 401k, there are provisions in the code that allow you not to have to take out your RMD. That's a whole nother conversation, but just make sure that you don't run afoul of that myth number 5.
What about rental income?
Rental income, most of the time, it is passive income. So unless you are really showing boots on the ground that this is your active income, which the majority of people is not, if it's passive income, it does not count as your income, which allows you to put away into an IRA or a Roth IRA. So great point there, John.
Good tip. Yep. And so myth number 4. So thinking your annual QCD is limited by your RMD amount. So a lot of
well, what's QCD mean?
Exactly. A lot of 3-letter acronyms there. QCD is a qualified charitable distribution. So once you hit the age of 70 and a half, you can actually direct your charitable giving from your qualified retirement accounts, from your IRA. What that allows you to do is basically move money out of your IRA to a charity of your choice and not pay any taxes on it. Beyond that, once you hit the RMD commencement age of 73, that charitable distribution can count towards your RMD. So I'll use my $10,000 example. Let's say your required minimum distribution is $10,000 and you want to give $2,000 to a charity of your choice. You can do that. That $2,000 gets deducted from that total RMD amount, and you only have to take and pay taxes on 8 of it. But here's the myth on this is people thinking that you are limited just by whatever that RMD amount is. In the example, 10,000, you can actually do up to $100,000. So if you're feeling very generous, you could clear your RMD and give even more from your IRA and not pay any taxes on it.
Actually, listeners, viewers, that number has increased to 105,000 for this year. The Secure Act actually put in a provision for inflation to it. So very important on the QCD, especially if a lot of you are using the standard deduction. You may be donating to a charity and not getting any credit for it. So you might as well donate to a charity, but also get the tax benefit by utilizing your IRA. There's provisions and requirements on how to go about that. So don't just do it lightly. Obviously, if you have questions, we're here for you on that. So that's a great one. Myth number 3, not understanding the RMD aggregation rules. So this is a big one. We get a lot of questions on this because a lot of you may have multiple IRA accounts. And the way the aggregation rule works is if you have multiple IRA accounts, the IRS allows you to figure out what your value is of how much you have to pull out of the IRAs for the RMD for that year, but you can pull it out of one of the accounts. You can pull it out of 2 of the accounts. You don't have to do a pro rata from each of the accounts. Very, very important. But what's the one caveat that people get confused on?
Yep. 401k plans are employer-sponsored retirement plans. You mentioned islands before. Those are islands in regards to RMDs too. So again, if you have 3 different old 401ks, the RMD must be taken from each of those accounts for whatever that amount is to that respective account.
So if you have an old doormat 401k account, that's the one benefit of doing a rollover to an IRA. Not only you have more options on the investment sides a lot of times, but now you won't lose that particular RMD, or you can aggregate it in. So very important. You can aggregate your IRAs for the RMDs, but you have to look at a company sponsored plan, 401k, 403b, 457 as its own island, and you don't want to make the mistake of not taking out the required minimum from that account.
Right. And myth number 2, or pitfall really number 2, is not even taking a required minimum distribution at all. There are penalties associated with that. And, you know, some people might say, I'm just not going to take it. And I can pay it once, from my estate once I've passed. You can't do that. You want to make sure that you do take that required minimum distribution each year.
Yep. And again, back to one of our earlier points, if you realized that you forgot to take an RMD out in a particular year, what you want to do is, number 1, figure out what that amount was missed. You want to take that out immediately from your IRA account. Then there's a form that you can file. And a lot of times, if you can show that you did forget that, and then you realized it, or you got bad advice and you took it out, that a lot of times the IRS will forgive you, but that penalty has dropped from 50% to 25%, and then done in a timely fashion with a period of time, they'll actually lower it to 10%. So the key is, don't just put your head in the sand and think it's going to go away. With the IRS and the different types of technology now, most likely they're going to figure it out at some point.
Yep. And that penalty amount, those percentages, is the percentage of that missed year's RMD, and you still have to take the RMD on top of that as well.
And then the last mistake a lot of people make is just trying to determine out, how do I calculate what my RMD is? And it's pretty easy. It's the fair market value of your IRA account or 401k account as of the previous year on 12/31. And most of you will get a what's called a fair market value report from your custodian that will detail out what the amount is. Now, a lot of times they won't put in there what the actual RMD is. And so if you're a do-it-yourselfer, you're going to have to use the uniform table, or you're going to have to call the custodian. If you're working with a financial advisory, a planning firm here at Baintree, that's one thing that we do help our clients with, is making sure that they know what the RMD is for each of the accounts and making sure that they don't miss taking one out. But most importantly, it's understanding what your age is in the following year and the value that's used. If you don't have that, you're in a lot of trouble.
Yep. Absolutely. So hopefully those points were valuable to you. If you do have any questions on anything we discussed or even outside of what we discussed today, feel free to reach out to us, send us an email, info@baintree.com. And,
Yep.
Happy planning out there this year.
Yep, we do appreciate it. RMDs are definitely not a fun part of the retirement game, but they are an important piece of the puzzle. We're here for you if you have any questions. If you found this video to be educational, hit the subscribe button or forward it on to somebody else that might benefit from it. We appreciate you. Happy planning, everybody.